The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Oh, happy Monday, everybody. Welcome to Scorebox Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. US President Donald Trump hits out with a new 15% global tariff, the maximum allowed under the law after the Supreme Court strikes down his sweeping reciprocal levies.
I'm ashamed of certain members of the court, absolutely ashamed, for not having the courage to do what's right for our country.
A deal's a deal. The European Commission says it expects the US to honour its trade pact following Friday's SCOTUS ruling, whilst the top White House trade envoy insists Washington will not pull out of its current agreements.
These deals are going to be good deals. We expect to stand by them. We expect our partners to stand by them. And I haven't heard anyone yet come to me and say the deal's off.
Well, after the initial cheer in equity markets on Friday, Trump's tariff retaliation puts European futures under pressure, with Wall Street also poised to start the week firmly into the red.
A very good morning to you. How are you?
Yeah, very well. How are you?
I'm great. Yeah, I had a very busy weekend and obviously digesting everything on the work front as well. Look, I have a question for you.
Fire away.
How many Republicans versus how many Democrats are on SCOTUS, the Supreme Court of the United States? And I can tell you the answer straight away, by the way.
Don't tell me.
The answer is 6-3. There are 6 Republicans and 3 Democrat appointees. Sotomayor was appointed by Obama, Kagan, Obama, and Brown-Jackson by Biden. Trump, and I won't go through all of them, but Gorish, Kavanaugh and Barrett were all appointed by Trump and others by George W. Bush, and actually one by Clarence Thomas by George H.W. Bush. Now, the point I'm making here is that you can even have a Republican bias, which the president would have perhaps hoped would have done his bidding, and still it doesn't matter because the Supreme Court has chosen what is the legal decision in their view rather than the partisan decision. And I think that has big ramifications, by the way, for the FOMC going forward as well. You may appoint a certain gentleman, such as, dare I say it, Jay Powell, who was appointed by Donald Trump.
Yeah.
Or you can appoint Kevin Walsh, but it doesn't mean to say that institutions will do your bidding. And I think that's very important. And I think it speaks a lot to the power that Donald Trump maybe has or maybe doesn't has as well. Right, now going forward.
And it goes beyond that. I think to pick up your point,
Sure.
This is one of the first times we've seen a really significant check on the extent of presidential power.
I think you're absolutely right.
And with the case against Lisa Cook, what the implications are for that. Things like the president's solo decision to end the birthright, citizenship birthright laws. There could be ramifications that go beyond this, reflecting the fact the court is actually willing, despite that Conservative majority, is willing to rein in the president's use of power.
What does it mean about the perception on Congress of Republicans there about whether the president still controls their bidding, or does they do his bidding as well as we move up to the midterms where the president is, dare I say, at the moment, moderately unpopular?
And even sooner than the midterms, I'm glad you mentioned Congress, because on Tuesday, what have we got? The State of the Union address. A potentially awkward moment because traditionally the Supreme Court justices sit on the front row.
Oh, that's very interesting.
That
I didn't
will be
know that
a
last
fascinating exchange to see.
So in terms of the data as well, there's a lot out there, and I put out a small piece on socials this morning because the Global Trade Alert, for instance, have said, actually, this isn't going to benefit the net is actually that the likes of China, the likes of Brazil, the likes of India will have less tariffs, and allies, erstwhile allies like Singapore, Italy, United Kingdom, actually have higher tariffs as well. So it's very complicated, and we actually don't know. Let's be honest about it. It was 10% on Friday, and then it changed to 15% in the last couple of days as well. So it's a fast-moving feast. And as the president has actually quite rightly said himself, well, what does it mean for whether we have to give the money back? By the way, we're not giving the money back, but obviously whether it goes through the courts and all these US corporates and states that have challenged the president, whether they go through that whole process remains to be seen. Well, let's go through the details. The US Customs and Border Protection Agency has said it will stop collecting tariffs deemed illegal by the US Supreme Court at midnight Eastern Time tomorrow. That's after President Trump's tariff based on the International Emergency Economic Powers Act, IEPA, was struck down by the Supreme Court on Friday, prompting Mr. Trump to impose a new 10% global levy under Section 122 of the 1974 Act, before raising that, as I say, to 15% on Saturday. Fast-moving feast. The Supreme Court decision effectively upheld a lower court's ruling that Mr. Trump did not have the right to impose tariffs under IEPA. The decision, 6-3, was not split on ideological lines. Trump called the ruling, quote, ridiculous, extraordinarily anti-American. The president also suggested that the 6 Supreme Court justices who ruled against his tariffs were swayed by foreign interests, which he did not back up with evidence. The ruling also opened up the possibility of refunds for companies and businesses affected by tariffs. Speaking to reporters on Friday, President Trump dismissed the idea he would be paying anyone back anything.
Wouldn't you think they would have put one sentence in there saying that keep the money or don't keep the money, right? I guess it has to get litigated for the next 2 years. So they write this terrible, defective decision, totally defective. It's almost like not written by smart people. And what they do, they don't even talk about that. Your question is very basic. That was the first question I asked also to make you feel good. I said, what about all the money that we've taken in? Sir, they don't discuss that. How crazy is that?
What you're saying is, are you saying that you don't plan to honor refunds for companies that file for them?
I just told you the answer, right? I told you the answer. It's not discussed. We'll end up being in court for the next 5 years.
Let's just take a look at the markets, and this is how the main markets on Wall Street closed the day on Friday. To just give you a top-line recap, the S&P and the Nasdaq had their best day since the first week of February. Communication services had the best day since the end of January. Industrials, that sector, posted a record close. The dollar index had its best week since early October, and oil had hit 7-month highs. Now, taking a look at the week overall, the Dow actually closed up 0.3% on the week. The S&P 500 gained, notes going all over the place. The Dow 0.3% up on the week. The S&P 1.1% on the week. Nasdaq climbed 1.5% on the week. Of course, the US markets were reacting in the trading session on Friday to the Supreme Court decision. What they had not had was the full implications of President Trump's response to that, the 10% and then subsequently 15% global tariff. So that remains to be seen throughout the day today. In terms of European futures, this is the open that's being called across Europe, all of them firmly into the red as the investors here dissect and analyse and digest the implications of the Supreme Court decision and then the subsequent tariffs, that 15% across the board that President Trump announced on Saturday. To the picture on Wall Street when they began trading at the beginning of the week, again, all firmly into the red, as you might expect. We will keep a check on that for you throughout the morning. Steve.
Very good. Okay, shares of Blue Owl Capital. I think this is fascinating. Shares of, I'm kind of concentrate all the macro stuff, but this, I think, is a really, really important story for all of you. So, shares of Blue Owl Capital extended losses on Friday after the alternative asset manager began selling assets to return investor capital, stoking fears around a liquidity crunch in private markets. Private markets, I mean, I spent most of 2025 asking people why all of a sudden private markets are all such a hot area. I think I might be spending most of 2026 telling them why it wasn't as hot as they thought it was. Last week, Blue Owl said it will sell $1.4 billion worth of assets across 3 funds in order to pay down debt. The stock is down more than 25% so far this year. Well, Blue Owl's co-president and head of credit, Craig Packer, told our US colleagues on Friday that the asset sale was a mark of the firm's continued strong position.
We sold $1.4 billion across 128 names in the portfolio. It represented a cross-section of about half the book, generally consistent with all of our industry sectors, all the types of loans that we make, and we sold them at par. Fair value, 99.7. I think most in the industry that follow this say the ability for us to sell that size at these prices is actually a validation of value. And people have been asking questions about marks, and here we are with significant third-party sales at par.
That's a fair point, actually, isn't it? If they're managing to get out at par, very good. But what was the valuation marked before they got out at par? Anyway, let's move on. Michael Eakins is with us, Chief Investment Officer at Phoenix Group. Michael, good morning to you. I almost don't know where to start. There's so many amazing stories for Ben and I to digest this morning, but lovely to see you. I know where to start. Let's start off on tariffs. Just your impressions, your thoughts, having read as much as we have this weekend.
Yeah, well, look, Friday was a tumultuous day. We started the day in London with some really positive economic data coming out for the UK. And then, of course, all of that was usurped by the judgment coming out at around 3:30 London time from the Supreme Court, which really pulled back the Trump administration and said that they'd overstepped their authority in putting through the tariffs. It's all about where do we go from here. We saw what Trump has done over the weekend, the 15% tariffs, but that he has to take that through Congress within 150 days.
Yeah.
What we're seeing this morning as markets have opened up, sort of Hang Seng up, other Asian markets down, and we expect markets to open up down. But again, it's just digesting the sort of geopolitical volatility that's coming from the Trump administration.
Look, I don't want to be glib about it, but the markets are doing their own merry dance regardless of tariffs, it seems. There's a lot of other things they're more concerned about, whether it be SARS-ageddon. Was it you who wrote that, or was it one of your... SARS-apocalypse, that's yours, isn't it? I can't even say it. It sounds like I'm saying ancient Greek. SARS-apocalypse. Okay, well, we'll come to that in a moment. But there seems to be a lot more things that the market is more worried about than Trump and his merry dance on tariffs.
Yeah, absolutely. Look, markets are focused on some of the fundamentals around economic growth, around the indebtedness of many sovereign nations in terms of their debt to GDP. The tariffs is absolutely a distraction, and it does weigh heavily on investor sentiment, on a very episodic basis.
Right.
Just to pick up on that, obviously there's so much to be to see clarity on regarding the tariffs and their implementation, what it means for prices that US consumers pay in the shops, that businesses pay. What do you think this does in terms of the job of the Fed, and especially under the new chairmanship? It really clouds the picture for them in terms of knowing what direction prices may go in, doesn't it?
Absolutely. Look, with a new chair of the Fed coming in May, Kevin Warsh, his mandate is pretty clear. And to be fair to the incoming chair, he's been clear on what his priorities are. What will those priorities be? They'll be around reducing the size of the Fed's balance sheet. He does not believe in as active QE as we have seen. And we're also likely to see some further forward-looking monetary easing. But these geopolitical events and tariffs and the uncertainty that brings about, you're absolutely right. It does muddy the water somewhat.
To pick up on the phrase that Steve saw in your notes.
Steve tried to say, but couldn't quite say it.
It's a portmanteau, isn't it? SaaS and apocalypse.
Sarsocalypse. How do you say it?
I'm not even going to attempt to say it. I'm happy to talk about it.
Mr. Eakins, this is your copy. Sarsocalypse.
Sarsocalypse.
No, I want Michael to do it. Come on.
Software as a service provider.
No. This is in your copy. Sarsocalypse.
Sarsocalypse. There you go.
Just to pick up on that idea, whenever we see a big sell-off, there are inevitably winners. Now, the software as a service stocks have clearly suffered from the Claude trade. Who do you see as the winners? Because someone must win if they can get greater efficiencies and reduce their costs as a result.
Absolutely, and we do believe in that. And as it relates to that sell-off, you really have to look at the different software as a service providers. You've got the horizontal providers who provide software across different industries, across sectors, where the technology could be penetrated and disrupted by AI, and where the spend on those providers may be seen as a nice to have, as a must have. However, conversely, the vertical software as a service providers, the ones who are really deep-rooted within industries and are fundamental to the operating environments of companies and sectors, and we see this in life sciences and pharma, we see this in restaurants, they are likely to be the winners because their technology is far less likely to be disrupted by the advances in AI. So we really do look into the detail and don't just look at it at a high level.
Do you know, there was another acronym that I read over the weekend, which were like the Halo trade, high assets, low obsolescence. I love these phrases.
What does that mean?
It means that companies that are heavy on assets and are the sort of the old economy, I suppose consumer staples, that sort of thing, rather than the software companies where things are more intangible, are the ones that may prove to be more resilient.
Okay.
High assets, low obsolescence.
Got it. Thank you. Michael, what do you think about these private credit markets? I know that Phoenix is very interested in that area. A lot of other asset managers and financial providers are getting very excited about it as well. I've always had my concerns. I didn't think it was an area that was actually that starved of capital to begin with. I think a lot of retail investors have been encouraged to get involved in private credit markets where they don't actually know what they're doing. But the Blue Owl News, I want to get your views on what you see going on in private credit.
Yeah, look, we are material investors in private credit. We do not invest in organisations like Blue Owl or indeed in funds. When we invest in private credit, we do it bilaterally with the lender, where either we are the sole lender or we're part of a club of lenders. And so when we do it, we have direct engagement with the borrower, I should say. We get to know and understand the credit really well. We have a really rigorous underwriting standard, which we absolutely adhere to, and credit ratings. And we pass on many, many more private credit assets than we invest in.
So you agree with what I'm saying? There's a lot of fluff out there, but what I think you're trying to say, there is a very responsible level of lending to private credit, and then there is the path that a lot of retail investors have been trying to get encouraged to get involved in.
Absolutely. Look, when we invest in private credit, it's solid investment grade. The average rating of our portfolio is A flat to A minus. So we tend not to get involved in the areas where we've seen recent news headlines.
Do you want to have another go at that word?
Sassocopoulos?
You're going to regret ever having that in your
It wasn't even me. That was one of my colleagues.
Who was it? Let's call them out at Phoenix. Who was it?
It was my amazing market strategist, Anthony O'Brien. Who
oh,
was
you
absolutely
did? You called him out? I didn't think you were going to do it.
He's brilliant.
I honestly didn't think you were going to do that, Mike. Anthony O'Brien, you're amazing, but apart from that word, very good, sir. Thank you.
Actually, record a clip of you saying it and send it to us so that we can have an example to follow.
Michael Eakins, Chief Investment Officer at Phoenix Group. That's been a lot of fun. Thank you very much indeed.
And still to come on the show, European leaders react to the US Supreme Court ruling urging Washington to honour its commitments. We'll bring you more reaction from this side of the Atlantic right after the break. Plus, the White House confirms that Trump will visit China late next month for much-awaited discussions with President Xi. We'll have more on that later in the hour. And we'll get the latest IFO data out later today. Join us for a wider discussion about the German business climate with Clemens Fuest, President of the IFO Institute, at 9 o'clock GMT.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts. US Trade Representative Jamieson Greer met with top EU official on trade Maroš Šefčovič on Saturday after the Supreme Court's ruling amid uncertainty about what the president's new tariff announcements will mean for existing deals. Speaking to CBS's Face the Nation, Greer said those agreements will remain in place.
I've been telling them for a year, whether this case, whether we won or lost, we were going to have tariffs. The president's policy was going to continue. That's why they signed these deals, even while the litigation was pending. So we're having active conversations with them. We want them to understand that these deals are going to be good deals. We expect to stand by them. We expect our partners to stand by them. And I haven't heard anyone yet come to me and say the deal's off. They want to see how this plays out. I'm in active conversation with them on it.
The only person who thinks if you squint, you see Wayne Rooney rather than Jamieson Greer. Jamieson Greer, Wayne Rooney, never see them both in the same room. Moving on, the European Commission issued a statement after that meeting with Greer urging clarity from the US government on the steps it intends to take, saying the EU expects the US to honour its commitments and that it will not accept any increase in tariffs above the level already agreed. European Parliament lawmakers on the Trade Committee will hold an emergency meeting later today with the chair Bernd Lange taking to social media to say he will propose a pause to all legal or legislative work until the EU secures clear commitments from the United States.
The French Trade Minister, Nicolas Forissier, suggested that Brussels could hit back at Washington for its latest round of tariffs. In an interview with the Financial Times, Forissier urged EU members to, quote, no longer be naive and adopt a united approach against Trump's new 15% global tariff rate. Charlotte joins us now. Interesting, just as we saw with Greenland, France sort of taking the lead in pushing back against what's coming out of Washington.
Yes, and certainly like what we saw in January, you have more feisty kind of talk back from France there when it comes to the tariffs. But look, on Friday, we saw the CAC 40 actually hit new record above the 8,500 mark for the first time ever off the back of the Supreme Court decision. And of course, it's the export-oriented stocks that move the most, and the heavyweights in the CAC 40, the luxury ones, LVMH up 4.5%, Hermes 3.5%, and of course the drink makers as well, because these are the sectors that are most exposed to the US. So you had Pernod Ricard and Rémy Cointreau also higher on Friday off the back of the Supreme Court decision. Now, of course, when you compare France to Germany, France is less exposed to their exports to the US. The impact is much lower. It's 1.6% of GDP for France against 3.8% for Germany. But again, some sectors are very, very much exposed to the US. And that's, again, the case for the drinks makers in particular. Now, the key sector for France when it comes to the US, of course, is aerospace. And that's an area that is exempt, and the White House confirmed over the weekend that this will continue to be exempt. So certainly a relief on that front. But what we heard from President Macron over the weekend when he spoke on the decision, first he praised the role of institutional checks and balances without directly criticizing President Trump. But he also said that France would consider the consequences of Trump's new 10% tariffs.
On va regarder. We will look exactly at the consequences, what can be done, and we'll adapt. Fundamentally, what is it that we want? To continue exporting our agricultural products, our luxury goods, our fashion, our cosmetics, our aeronautics, basically everything that we're good at exporting, and having other new products to export. Because we continue to re-industrialise this country, and we do it with the fairest rules possible. And so the fairest rules possible involve reciprocity and not being subjected to unilateral decisions. So if this helps to pacify things, that's good. And I think we should be rather in a mindset of international appeasement and continuity in the modernisation of our economy in all these sectors.
And that was President Macron speaking on Saturday. Of course, since then, the tariffs have been moved to 15%. But what we heard again from the French ministers, including the Foreign Affairs Minister Jean-Noël Barrot, said that the entire edifice that had been negotiated has collapsed, of course, referring to the EU-US trade deal that was agreed last summer. So now they say it has to be an EU joint response there, reminding, of course, Europe has the so-called trade bazooka, so these anti-coercion instruments, saying they can have that in the bag if necessary. So here again, we have to wait this week. But what we know is that this extra uncertainty for companies and businesses, the industry in particular, on what these new tariffs mean, this decision means, and what that means for the EU-US trade deal as well. OK,
Charlotte, thank you very much. We'll see you a bit later. And the question is what it means for businesses globally. And Andrew Wilson is the Deputy Secretary General at the International Chamber of Commerce. Andrew, your organisation represents, I believe, more than 45 million companies in over 170 countries. What sort of reaction are you getting to them from the weekend's fallout, the Supreme Court decision, and then Trump's new tariffs?
Well, good morning from Paris. Look, I think the view from businesses is pretty net negative, I would say. I mean, look at what businesses were hoping for going into this ruling. It was really two things at its core. First was a clear pathway to secure refunds on the duties that have been paid over the past year. That's completely unclear. And then secondly, I think there was widespread hope that an adverse ruling against the administration would encourage them essentially to place a pause on the use of tariffs, so move away from the tariff-first trade policy we've seen over the past year. And again, we seem to be heading in the wrong direction there.
Given the events and what we've seen, what does the International Chamber of Commerce want to see as an ideal outcome, and how likely is that?
Look, I think the question of refunds is key for many businesses, particularly those companies that have had their balance sheets strained by the duties over the past year. And JP Morgan, I think last week, showed how the tariffs have really impacted mid-sized companies in the US in particular. So what we'd like to see is the US Customs Authority come forward with very clear administrative guidance on who's eligible for refunds and how those can be claimed. I think that's very, very unlikely. We tend to think we're going to end up in a situation where companies have to litigate to secure refunds, which will severely dent eligibility in many cases. I think more broadly on the trade policy front, the US administration needs to be as clear as possible in terms of what it plans to do with new sectoral tariffs or country level tariffs, and be very, very careful to preserve the bilateral deals that is secured over the past year. What we don't need at this time is new uncertainty or the prospect of higher tariffs in the future, at least in some product areas, further chilling business investment and hiring decisions.
Andrew, the equity markets have been pretty glib and oblivious almost to what's going on in trade policy ever since they had their hiccup in April last year and then recovered and then have moved on from there as well. US corporates are having amazing earnings in the final quarter of last year as well. So on an earnings front, despite the cost of tariffs for those importing US companies, and on a markets front, we seem to be ignoring it. Do you think actually that the markets and individual corporates are right to ignore this? Actually, business as usual doesn't seem to be that bad regardless of tariffs.
I mean, I think it's important not to overstate the potential impact of the US tariffs on the performance of US companies and also companies globally. But I think there is often a bit of a disconnect between Wall Street and Main Street. When we speak to companies about the impact of the tariffs, the sentiment is very, very negative, similar to what you see from the polling data from US voters. A sense that the uncertainty around the US's direction of travel is ultimately chilling investment and hiring decisions and is making doing business with the US far more difficult. And I think the one thing we see from companies across our network outside of the US is a focus on market diversification, so trying to move away from the US market as much as possible, which we saw, I think, from Brompton Bicycles just last week.
That's very interesting, and we wish Brompton Bicycles the best of luck because it's a very tough market for them as well. But look, the fact of the matter is this diversification trade you talk about as well, do we actually think it's going to happen meaningfully? In the same way that I don't believe the de-dollarization story has gained any traction since people started talking about it 30, 40 years ago, in any meaningful way anyway as well. The diversification strategy away from trading with the US, is it actually happening in any way, shape or form?
I mean, what we see very clearly from companies is a focus on obtaining new market access away from the US market. And some of that started, I think, in anticipation of the Trump administration coming into power. So this is something that's been going on in many companies for 18 or even 24 months. I think to your point, the key thing is it's easy to talk about moving away from the US. It's more difficult to do it in practice. There's no comparable market, particularly in consumer terms, to the United States. So I think we need to be nuanced in terms of how we approach this issue ultimately. But there is a trend ongoing. And the point I would make to the US administration is if you want to make America great again in terms of domestic manufacturing, in terms of the health of consumers, are tariffs the right way to go about this? Or do you need to be thinking differently about some of the challenges that we see in the global economy, particularly the issue of global imbalances?
Andrew, you rightly say there is no market really, no single market to rival the US, but we have seen in the opening weeks of this year trade deals done between the EU and India, trade agreements between the UK and India. Do you think this latest, I suppose, the convulsions regarding the tariffs over the last few days will expedite agreements and deals between countries and regions among themselves so that they do have another option if things continue to be as turbulent in the coming months?
I think it will certainly confirm that trend towards countries looking to strike bilateral or plurilateral deals. And it's all part of the market diversification strategy that Mark Carney, President Macron and others have talked about over the past year, particularly in recent months. But I think, these deals, albeit important economically, albeit very important symbolically are not going to fundamentally change trade flows or rewire trade flows overnight. So the US will remain important. I think the key question from our perspective is, where does the US go now on tariffs and its broader economic strategy? And I think keeping in place those bilateral deals that it has already secured over the past 6 months or so is very, very important. I think we can expect to see some unfortunate pressures there, particularly within Europe, as your earlier segment showed.
I had a great chat with Nicolas Fourissier, man, I'm sure you know very well, in Paris, in Davos this year as well. And whilst I think it's great that Monsieur Macron and Monsieur Fourissier are kind of speaking very strongly about what Europe can do, let us be brutal honest about this, Andrew. Whilst the war is raging and Europe needs the US security umbrella, is there anything that Šefčovič, Fourissier, Macron, von der Leyen, is there anything they can meaningfully do to face down the United States?
Look, I think it's well known that one of the key underpinnings of the Turnberry deal was securing America's engagement in Ukraine. Nothing has changed in that respect. So we wouldn't expect, despite some of the political noises we've heard over the past 24 hours, to see Europe walk away from the Turnberry deal. Nor, frankly, would we expect any other governments to rip up the deals they've done with the US in recent months. But I think what we will see is growing turbulence. So really, I think domestic political pressures saying, why have you granted trade concessions to the US in return for a softening of tariffs that no longer apply? So I think stabilizing those relationships will be important. And I don't think the US can take that necessarily for granted.